లాస్ట్ నెంబర్ తర్వాత పెడతాను సార్. నెంబర్ వేసాను, పేరు తర్వాత పెడతాను.
ఓకే
సార్ ఇంట్లో చెక్ చేసి
ఓకే సార్.
సార్ మాట్లాడండి.
Okay. A very good morning to all the students. So welcome to the CFR Fastrack batch. Corporate Financial Reporting, Paper 18, Group 4 of CMA Final. In this Fastrack class, let's see what are the chapters we are going to cover briefly. Of course, we are going to cover all the chapters. So, but let's look at the focused chapters. So, with respect to Indian accounting standards, so for this attempt, especially for June attempt, income taxes, Ind AS 12. This is one of the important chapter. Second thing, Ind AS 116, because in previous attempt there is no question on Ind AS 116. And next important chapter is Ind AS 102. So definitely we are expecting question from Ind AS 102 and as well as Ind AS 116 leases. Okay, of course Ind AS 12 is also important, not only with respect to the Ind AS 12. For solving the problem of Ind AS 103, Ind AS 12 knowledge is required. So in that perspective also Ind AS 12 is important. And so for this attempt especially, so these three standards are important. Along with this, every time repeating standards are Ind AS 16. So last time also there is a 14 mark questions from this set. Ind AS 16, Ind AS 36 and Ind AS 38 intangible assets. So these three chapters are one set. Okay. So we cannot differentiate. We cannot say that if you are able to solve the Ind AS 16 without knowledge of Ind AS 36 impairment of asset. So should have the knowledge of impairment assets if you want to solve the problems from Ind AS 16 and as well as Ind AS 38. So sometimes they are asking from the Ind AS 16 or Ind AS 8. So that's why we have classified these three chapters into one set. So every time we are expecting generally 7 marks, but last time 2 7 marks, means total 14 marks have been asked from this set. Maybe this time also we will expect same pattern, then we will get the 14 marks. If he changes also pattern, we may definitely get the marks from Ind AS 102, so Ind AS 12 and Ind AS 116. These are the very, very important. Ind AS 115, revenue from contracts with customers. So this is second important standard. Ind AS 115. They asked, so 7 mark questions will come from Ind AS 115. So these are the important standards with respect to Indian accounting standards. These are the important chapters. So and after that, coming to valuation of shares and accounting of financial instruments. From these two chapters, 14 marks are expecting. 7 marks from valuation of shares and 7 marks from accounting of financial instruments. So with respect to CMA final curriculum, it is not too much voluminous with respect of accounting of finance. Need to focus on how to calculate the present value of the financial assets or financial liabilities, and we should focus on the compound financial instruments. Compound financial instrument means it has the contain the element of equity component as well as liability. So present value of the future cash flows are the liability and the remaining portion is the equity component. So we should focus only on that aspect. Then coming to NBFC, NBFC is not important with respect to the questions. So this time I am just expecting MCQs from NBFC only. So this chapter is not so important. That too very small chapter. You should remember the provisional norms. Provisional norms means standard how much percentage of provision should be created. That aspect should be remembered. That's all. Then coming to our 14 marks questions. Ind AS 103, accounting for business combinations and restructuring. From this chapter, 140 marks. Definitely 140 marks is asking from Ind AS 103, and 14 marks is asked from Ind AS 103 in 8D or 8C, depends on sometimes. So in 8th question, 14 mark question is also will ask from Ind AS 103. Apart from that, at least 2 MCQs are asked from this chapter. So 14 plus 4 plus 4, total 18. 18 marks. Okay. Not only 18 marks, if sometimes they are asking from internal reconstruction also. The entire chapter is divided into two parts. The first part is business combinations and second part is internal reconstruction. If again last time also they haven't asked from the internal reconstruction problems. So if at all they have asked from the internal reconstruction also, they ask for 7 marks. There is a chance of asking for 7 marks from internal reconstruction. Apart from that, of course, there is 14 marks question definitely asked from business combination. So how many marks? 18 marks plus 7 marks equal to 25 marks. If anyone is being perfect in Ind AS 103, they can easily get 25 marks only if they are focused on Ind AS 103. Okay. If they also, the total is going to be 25 marks. Otherwise, it is at least 18 marks. Then coming to, one more aspect, you just remember it. If you want to solve the consolidated financial statements and separate financial statements, at least you should have the knowledge of Ind AS 103. Without the knowledge of Ind AS 103, you cannot able to solve the problems of consolidated financial statement also. So in CFS also, there is a 14 marks question. If anybody wanted to take the choice of these 2 chapters, so how many choices are there? I will give you the pattern of the exam also. So how many questions are asked? So total 7 questions, 7 descriptive questions. The first one is MCQs. So out of 7 descriptive questions, we should attend 5 questions. So there are 2 choices. If you wanted to take any choice, if anybody wanted to take the choice of Ind AS 103 and consolidated financial statements, they will face the problems, because if they already left for the choice, they should attend the each and every question from all these chapters. So they don't have any choice, they should read each and every chapter, because with respect to all these chapters, we don't know from where they could ask for the question. And they should prepare Ind AS 8, Ind AS 21, 23, 118, 113, so NBFC. So they should prepare each and every aspect. Okay, my suggestion is I will give you some important questions also. Don't leave the Ind AS 103 and CFS completely, of course. Okay, you can at least practice 2 to 3 questions from Ind AS 103 as well as consolidated financial statements. Okay, then you can able to, if at all, if any difficult question came from these remaining standards or remaining elements, at least you can able to attend this Ind AS 103 or consolidated financial statements. Sometimes the questions are very easy from these 2 chapters. At that time, you may lose the chance of getting higher marks, right? So don't take the chance. You have sufficient time, right? So try to focus on all the chapters. Then, my favorite topics, theory chapters, recent developments in financial reporting and government accounting in India. recent developments in financial reporting and government accounting in India. From the government accounting, they are asking for two 5 marks theory questions. Government accounting in India is completely a theory chapter. So we are expecting 10 marks from this chapter. Okay. And that too, it's a limited theory. It's not too much portion is there with respect to the theory. We can read it and we can manage it, the theory of the government accounting of India. And coming to recent developments in financial reporting, it's a combination of practical and theory. So from practical aspect, 7 mark questions. From theory aspects, we are expecting 7 marks. Of course, it contains too much theory when compared with the government of accounting in India. So, but that's fine. We will frame answers. So for each question, if you able to read one question, you can apply that answer to so many questions. So I will give you one answer and you can apply these answers to 4 to 5 questions. Okay. So we are going to frame answers in such a way. Okay. And coming to practical aspects, there are some more questions. So in practical aspects, only 3 elements are there. So one, economic value added. Okay. Market value added. Then value added statement. So last time there is a question from value added statement. So this time we are expecting question from economic value added. So from these practical aspects, every time they are asking simultaneously. For example, last time they have asked for value added statements. In the previous attempt, they have asked from EVA. So I am expecting EVA for this attempt. If you are able to, it will take only 15 to 20 minutes, that's all. For entire calculation also. So if you want to start the preparation, I suggest you to start with recent developments in financial reporting practical aspect, not theory. Okay, theory contains too much portion. So if you are able to solve this economic value added, then you can easily get 7 marks. Okay. Then let's see introduction to the Ind AS. The Companies Rules 2015 made Ind AS applicable to the following specified entities. I will give small introduction with respect to Indian accounting standards. Introduction to Ind AS. So previously there are accounting standards. So companies should prepare their financial statements in compliance with the accounting standards. Okay. So but in India they have introduced Indian accounting standards in the place of accounting standards. So in the place of accounting standards, the government introduced Ind AS. So AS is different and Ind AS is different. Indian accounting standards. So accounting standards knowledge should have at CMA Inter. So at CMA Inter level, you have learned the accounting standards concept. Now at CMA final level, you are going to learn about Indian accounting standards. So already we have accounting standards, right? Why then they have introduced Indian accounting standards? To compete with the international accounting standards. Okay. Then to match with the requirements of the foreign investors also. So we are introducing Indian accounting standards. These standards we have taken from IFRS. International Financial Reporting Standards. So we haven't taken directly from the IFRS standards, but we have converted the IFRS into Indian accounting standards, because we have taken some basic principles and basic elements from the IFRS, and we have made some changes according to the Indian economic situations. Then we have introduced Indian accounting standards. So this is a new rule. First thing, we cannot apply this rule to entire companies just like that, right? So the applicability is made in a phased manner. So whatever the new rules coming, that should be applicable to first which companies? Listed companies. Then some large companies in terms of net worth. Then with respect to the small companies. So the government wanted to implement the Indian accounting standards to all the companies in a phased manner. Okay, because all the companies are following accounting standards. Currently, all the companies are preparing their financial statements in compliance of accounting standards. If government introduced any rule, they cannot follow instantly, right? So they need some time. So, but of course, with respect to the listed entities and big companies, they have made these Indian accounting standards compulsory. Let's see what are the phases. So, from which date the Indian accounting standards are applicable to which companies? Let's see those dates. So I'm talking about currently the net worth criteria is 250 crores or more. One minute. IFRS means International Financial Reporting System. Then let's see the applicability. Applicability of Ind AS. Okay. So in this applicability, I'm talking about the current applicability. Okay. So of course there are initially the turnover, the net worth limits are 500 crores, then and all it been changed to 250 crores. But currently I'm talking about the rules. What is the current requirement? You no need to apply from the first itself. So currently the India is made applicable to listed entities. All the listed entities. Okay. So there is no net worth criteria. So the Ind AS is applicable to all the listed entities. Then for the unlisted entities, what is the net worth criteria? The net worth criteria is okay, greater than or equal to 250 crores. ₹250 crores. You just remember this aspect. That's all. Net worth criteria is 250 crores. But we need to remember the dates. So I have already told you the applicability of Ind AS is made in a phased manner. Like on 1/4/2016, it has been made applicable to all the listed entities whose 500 crores. And after that, 1/4/2017, it made applicable to all unlisted entities whose net worth is greater than or equal to 250 crores. On 1/4/18, applicable to NBFCs. The net worth is greater than or equal to 500 crores. Later than it been applicable to all the unlisted NBFCs whose net worth is greater than or equal to 250 crores. Okay, we just need those dates. On 1/4/16, so it starts with the 1/4/16. If you able to remember this starting date, then flow will come. Then 1/4/17, 1/4/18, 1/4/19. Okay. So with respect to these two dates are relevant for NBFC, and these two are other than NBFC. Of course, Ind AS is applicable to in the first manner, like in first phase or second phase. The rule is Ind AS is applicable to all the companies, all the eligible companies. I will tell you what are the eligible companies. But the rules are all the eligible companies except NBFC, insurance, and banking. Okay. So for these three companies, Ind AS is not applicable. Okay. But initially on 1/4/2016, when the Ind AS is applicable in India, if the straight question is asked when the Ind AS is applicable in India, we should mention the 1/4/16. Okay. Then on that date, all the eligible companies except NBFC, insurance, and banking. But still, today also for insurance companies and banking companies, Ind AS is not applicable because the approval is not received from the RBI respect to controlling authorities. But with respect to NBFCs only, Ind AS is made applicable from 1/4/18. I will tell you, sir, then why you are giving two dates. So on 1/4/16, it made applicable to listed entities unlisted entities whose net worth is greater than or equal to 500 crores. Then on 1/4/17, so it wants to increase the scope of Ind AS. So now it made applicable to unlisted entities whose net worth is greater than or equal to 250 crores. Okay. So in the same aspect, NBFCs also, all listed NBFCs and unlisted NBFCs also, the greater than or equal to 500 crores. So what is it? Here the criteria is net worth. You should remember it. Here also 500 crores. Then unlisted NBFC net worth greater than or equal to 250 crores. That's all. From these aspects, we are expecting MCQs. So currently, the applicability criteria are this one only. These are current applicabilities. Current applicability. Current applicability. But still, with respect to insurance and banking companies, interest is not applicable. But all the remaining companies, with respect to the unlisted, whether it is a normal companies or NBFC's companies, if it is net worth is greater than or equal to 250 crores, then we can made applicable of Ind AS. So those companies should prepare financial statements in accordance with the Indian accounting standards. Then how these rules are applicable? I am talking about the past. So it starts from 1/4/16. In 1/4/16, it made applicable to all the unlisted entities whose net worth is greater than 500 crores. That is the rule. So those are the initial rules. Again, they have made applicable to the companies even though the turnover is greater than or equal to 500 crores. Okay. Then, and also we should remember the dates. from which date the Indian accounting standards are made applicable to NBFC. I will give you the dates: 1418, 1419, then 1416, 1417. Tell me the answer. The Ind AS is made applicable to NBFC from which date? 1418. Okay. If nothing is mentioned, whether it is a listed or unlisted, or you haven't given any net worth information, we should defaultly say that 1418. So with respect to other companies, we can defaultly say that 1416 is the dates. If any criteria is mentioned, then we should check whether it is 1416 or 17. With respect to NBFC, 18 or 19. That's all. With respect to this chapter, these are the important elements you should remember. So that's why in our concept book also haven't mentioned anything regarding with the 500 crores net worth criteria. It may create confusion. So currently the net worth criteria limit you should remember is 250 crores or more. So is any net worth criteria with respect to the listed entities or companies in the process of listing in India or outside India or parent? This is an important point. Let's see. Parent, subsidiary, associate, joint venture of the above. For these also, no need to check the net worth criteria. We should we should make the applicability of the Ind AS to these companies. So there is a chance of asking for MCQs from this element. Okay. Okay. Then companies listed in SME. So it's a normal thing. SME means small and medium enterprises. So this is also not applicable. So only we need to check the net worth criteria. So with respect to companies listed in SME also, it's not been. If at all this net worth is generally, if it is greater than 250 crores, then we are not supposed to call it as SME. Okay. Then with respect to NBFC also, currently we should remember the 250 crores or more. Now, still the Ind AS is not applicable to banks, insurance companies, and it's an urban cooperative bank, rural region banks. For all these, Ind AS is not applicable. Okay. Let's look at the Indian accounting standards. Out of these Indian accounting standards, let's identify the which Ind AS are applicable on our CMA final curriculum. So Ind AS 102, share-based payments. So share-based payments means at your CMA inter level, it's called ESOPs. One ESOPs concept is there, like, so same aspect. Then Ind AS 103, business combinations. And of course, this 105, non-current assets held for sale and discontinued operations. Direct standard is not there, but its relevance is there. Its relevance is there while solving the problems with respect to Ind AS 103 and as well as Ind AS 16, Ind AS 8. So while we are solving the problems, you can so these you can see the Ind AS 105 names. So there are no specific questions from Ind AS 1. Remember the name, that's all. Let's see what are the accounting treatment when the assets are classified. Is going to be classified from Ind AS 16 to Ind AS 105. In that aspect only, Ind AS 105 name should be remembered. Okay. Then operating segments. Before that, Ind AS 107 is there. Financial instruments disclosure. We have the chapter of financial instruments, right? So financial instruments is discussed by three Ind AS. Ind AS 103, Ind AS 107 about financial instruments disclosures. And Ind AS 109, financial instruments measurement. Then what is the next aspect? No. Ind AS 32, financial instruments presentation. So on the standards names, there is one MCQ. So the standard names of financial instruments are used for one MCQ. So India is 32. How many standards are deals with financial instruments? 3 standards. What are they? India's 32 financial instruments presentation, India's 107 financial instrument disclosure, and India's 109 financial instruments measurement. So on in respect of the aspects, India's 109 is important. Okay. So we need to solve the problems, right? So those problems are solved on the with the knowledge of the financial instruments measurements. So remaining disclosures and presentation parts are it's an ancillary topics. Okay. But we should remember the names. Which accounting standards are deals with which part of the financial instruments. There is one specific MCQ in that there is a chance of asking with respect to the financial instruments disclosure, which India's is dealing with it. India's 107, 8, India's 109, and as well as India's 32. What is the answer? With respect to disclosures, India's 107. With respect to measurements, India's 109. Of course, we can easily remember the India's 109 because in so many other standards also this reference is going to be given. Okay. But we should remember at least India's 32 financial instruments presentation. Then, so in 108 operating segments. So with respect to India's 108 operating segments, we should remember the percentages. Okay. Then India's 110. Okay. India's 110 consolidated financial statements. Of course, main definition, control definition is given in India's 110. Then India's 111, India's 112. All these are going to be discussed in CFS, consolidated financial statements. These 3 standards are going to be discussed in consolidated financial statements and separate financial statements. One chapter is there. Then 113 fair value measurement. I am just identifying the out of these standards what are the standards which are covered in our syllabus. Then India's 115 revenue from contracts with customers. Previously they have introduced India's 11 and India's 18. Now they are replaced. These 2 standards are replaced with India's 115. Then India's 116 leases. This standard is important for this attempt. Then India's 7 is not there, India's 8 is there. Again India's 8 syllabus. Accounting policies, changes in accounting estimates and errors. Super. India's 12 income taxes. Again it is an important one. And India is 16. Every time, for every attempt, it is an important. Irrespective of the attempt, we are expecting a question from India is 16. Property, plant and equipment. So it's a 5-star one. Then what are the other aspects? India is 21 and India is 23. These are very small standards. Okay. And there is only limited questions also. If at all question is asked from 21 or 23, it's like a fetch for you. You can easily get the marks. Then India's 27, 28 is also covered under. So usually with respect to the associate concept, we will discuss in India's 103, like business combination. I am going to discuss the associate concepts in business combinations chapter, but with respect to joint ventures, we will have a brief discussion in consolidated financial statements. And this is a separate financial statements means CFS and SFS. We are discussing CFS and SFS as well as BC also. So that's why I told you before, the business combinations and consolidated financial statements are inseparable. Okay, so you should have the knowledge of uh, India's 102 business combinations if you want to solve the problems of the CFS also. Then what are the next element? India's 36. India's 36 impairment of assets. So there is a connection between the India's 36 and India's 103 also. So if you wanted to solve the problems of India's 103, so we should have the knowledge of India's 36 also. Next one, India's 38 intangible assets. This is also one of the small chapter. We can cover it within I think 1 hour. Okay. So these are our syllabus from the Indian accounting standards. Then let's start our discussion with PPE. Okay. So these are the applicable standards. Just I have given. These are the applicable Indian accounting standards which are in our CMA final syllabus. Before going into that, let's see the Schedule 3 format. So what is the format for the balance sheet, or what are the aspects covered in the Indian accounting standards? So as per the company's rules, we should follow the Schedule 3 format. But the Schedule 3 is divided into 3 divisions: Division 1, Division 2 and Division 3. And Division 1 is applicable for AS complying financial statements. So AS means accounting standards complying financial statements should be prepared in accordance with the Division 1 of Schedule 3 of their financial statements. And India's complying financial statements. The companies which are preparing their financial statements in accordance with the India's should follow the format of Division 2. And India's complying NBFC financial statement should follow Division 3 format. So what are the aspects important for our syllabus? Division 2, India's complying financial statements. Let's see what is the format of Division 2 of Schedule 3. So we already know that what is the format for Division 1 of Schedule 3. So in Schedule 3, in Division 1, the balance sheet starts with equity and liabilities, ends with assets. But with respect to India's 2, it starts with the assets and ends with the liabilities. That is the major difference between those two. Then, so let's see the format of India's. So part 1 balance sheet, and part 2 is statement of changes in, part 2 is statement of profit and loss account. So let's see what are the financial statements definition as per India's. Okay. So in India's, how many parts are there? So with respect to India's perspective, or in India's perspective, the following are the financial statements. The following are elements of financial statements. So now all we have know that the balance sheet, first one. What is the second aspect? It's not profit and loss account, it's a statement of profit and loss account. always you should use the word statement of profit and loss account. Statement of profit and loss account. And what is the third element? Cash flow statement. Okay. Cash flow statements. What is the fourth element? Funds flow statement. No, funds flow statement is not covered under financial statements. Okay. So cash flow statement, then notes to accounts. Notes to accounts. Next element is, this is an important aspect with respect to the Indias. All these four aspects are already covered in accounting standards. But what is the new aspect here? Statement of changes in equity. Statement of changes in equity. So shortly we can call it as SOKI. Okay. Statement of changes in equity. In this statement of changes in equity, there is a concept called OCI, other comprehensive income. So these are the elements of the balance sheet. So in this SOKI, statement of changes in equity, there is a concept OCI. OCI means other comprehensive income. Super. In this other comprehensive income, it's like a statement of P&L only. But this is the different aspect only available in India's, which is not available in accounting standards. Other comprehensive means most of the unrealized. No, I'm not saying all. Okay. So OCI contains mostly unrealized gains and unrealized losses. So differentiate between realized gains and realized losses, unrealized gains and unrealized losses. We have created the account other comprehensive income. So this is the concept introduced in India's. So mostly unrealized gains are transferred to this account, transferred to OCI instead of P&L. Okay. P&L means statement of profit and loss account. So these are the basic elements. Now let's see the format of this balance sheet as per the IND-AS, Indian Accounting Standard. So as per the IND-AS, we should follow the division 2 of schedule 3. Let's see the format of division 2 of schedule 3 with respect to balance sheet. So we don't have, barely we have seen that statement of profit and loss account. You no need to learn the format of statement of profit and loss account because there is no questions on this aspect. Only we should remember the format of balance sheet, that's enough. So it starts with assets. First, the assets part are divided into two parts: non-current assets, current assets. Non-current assets, it starts with the PPE. So PPE deals with Ind-AS 16. Then investment property is not in our syllabus, but I wanted to note down the name of Ind-AS of investment property. Investment property is dealt by Ind-AS 40. So there is some little connection between Ind-AS 16 and Ind-AS 40. That's why I want to remember the name of Ind-AS 40. Then Ind-AS mean goodwill. Goodwill arising in which standard? Goodwill is going to be arised in Ind-AS 103 and it is going to be impaired as per Ind AS 36. So with respect to the goodwill, Ind AS 103 and 36 is applicable. Then other intangible assets, it is Ind AS 38 and intangible assets under development also dealt by Ind AS 38 only. Okay. Of course, there are specific Ind AS with respect to the each line item, but I am just wanted to mention the names of the Ind AS which are in our syllabus or which are there is some connection between our syllabus portions. Then biological assets other than the bearer plants, it covered under Ind AS 41, that's not in our syllabus. Then coming to financial assets. Financial assets, it covers under Ind AS 109. Ind AS 109 means financial instruments measurement concept. So that's why I write it down only Ind AS 109. Of course, the disclosure parts are dealt by Ind AS disclosure parts 107 and presentation part 32. Okay. Then deferred tax asset concept. Tell me the Ind AS name. Deferred tax assets. Of course, consolidation there is a concept of deferred tax asset, but mainly dealt by Ind AS 12 income taxes. Okay. So there is, of course, there is a connection with Ind AS 103 also. Then so let's see the current assets. Inventories, financial assets, and all these are not required. Again these are repeating only. So non-current assets and current assets, and these are the aspects. So we will discuss one by one from these aspects. Okay, one more thing, equity and liabilities. So under equity and liabilities, it divided into three parts. First one, equity. What is the second aspect? Non-current liabilities, and third aspect is current liabilities. So you no need to by heart this format. Okay, automatically while we are following while we are solving the problems, the format is going to be habituated to us. Anyway, in question itself, the format of the balance sheet is given. With the help of the question also, we can able to solve it. So specifically, don't invest your time on by hearting of this format. Okay. So out of this, let's see how property, plant and equipment, these balance should be going to be mentioned here, right, with respect to current period and with respect to the previous period also for the comparison. Now how the amount is going to be arrived here, from where I have recorded the amount here. So this is the balance sheet, right? So I have for example, I have mentioned 55 lakh is the property, plant and equipment ledger balance. These 55 lakhs have been taken from trial balance. From trial balance to the trial balance, from where it has been taken? From the ledger of PPE. In the ledger balance of PPE, the closing balance is 50 lakhs. That should be recorded in balance sheet. But how this amount is given? It's a combination of transactions. How to initially record it, and after that it made changes to the property, plant and equipment. Then if you want to give a property, plant and equipment name to any assets, what are the criteria? I have purchased one land. Can I give the name of PPE? Can I classify it under the ledger of the PPE? Okay. So let's see what are the definition. If you wanted to classify one asset under PPE, and after that how to how to provide the accounting treatment, how to initially recognize in our books, and how to what are the further aspects on the Ind AS 16. Let's see Ind AS 16 property, plant and equipment. Ind AS 16, chapter number 2. One minute. So, sorry, chapter number 3, Ind AS 16. So, let's see the applicability. So, let's see the first term, non-applicability. So, this standard is not applicable to Ind AS 16. What is the chapter name? Property, plant and equipment. The standard name is property, plant and equipment. So Ind AS 16 is not applicable to PPE classified as held for sale. Already told you Ind AS 105, non-current assets held for sale. If you wanted to decide to sell it in the nearby future, so those should not be combined with the PPE. So it will give the wrong notion to the shareholders. They are thinking that these are the assets they are going to be retained with them to generate the economic benefits in the future. But they don't know you are going to be sell it in the near future, right? So to differentiate it, you are not supposed to call it as PPE if you wanted to sell any assets in the nearby future. So that's shown under the separated Ind AS 105, non-current assets held for sale. Then biological assets other than the bearer plants. So agriculture produce. So there is a separate standard called Ind AS 41. Of course, all agriculture produces or all the dairy related aspects all covered under Ind AS 41 except bearer plants. Bearer plants are again covered under Ind AS 16. Of course, these biological asset, bearer plant is also a biological asset. All the biological assets are covered in Ind AS 41 except bearer plant. Bearer plant is covered under Ind AS 16. Then, assets used in the exploration of the mineral resources, there is a separate standard. So, with respect to mineral resources, so covered under Ind AS 116. Then, mineral rights and mineral reserves such as oil, natural gas. So, all these assets are valued depends on the industry rules. They are following the industry rules. There is no specific rules given in standards. Then, these are the non-applicabilities. So what is Ind AS 16 is saying? Ind AS 16 is not applicable to all these assets. Then Ind AS 16 is applicable to only property, plant and equipment. Then what is meant by property, plant and equipment? So the definition of property, plant and equipment is given. So PPE means property, plant and equipment are tangible items. If you want to if you want to classify any assets under PPE, the first condition it is going to be satisfied is tangible assets. So PPE are tangible assets. First, what is the purpose? For any classification of the assets, so I need to go with the purpose. So for what purpose you have purchased this PPE? I am going to give three purposes. If you purchase this asset for these three purposes, for any of these three purposes, then we can classify it as a PPE. So let's see the purpose. First purpose, used in production or supply of goods or services. And second one, for rentals to others. And third one, for administrative purpose. One more thing, so there is a small change with respect to this element. Okay, should come from here only. So how many purposes? Three purposes. So for rentals to others, there is an exception, except land and building. Okay, so you have purchased a land, and here the purpose of the land is you want to give for others for earning the rental incomes. That land should not be classified under definition of PPE. So land is also a tangible item and the purpose is also rentals to others, but still it is not considered under the definition of PPE because there is a separate standard Ind AS 40 with respect to these standard Ind AS 40. Let's say I am changing the example. I bought one building, but the usage of this building is for administrative purpose. I want to bought a building for setting up one office in that building. Whether it can be classified under PPE? Whether it can be classified under PPE? Yes. So only with respect to if it has given rentals to others. Okay. Then I need to see whether it is a land and building. If the land and building is purchased with the intention to giving to others for the rental purpose, so then it should not be comes under the definition of the PPE. For all the remaining aspects, the remaining assets which are tangible assets, if at all those tangible assets are used in production of the goods or supply of goods or services, then we can classify it as PPE, and as well as for the administrative purpose. So I purchased one machinery with the intention to giving rentals to others. Can I classify it as PPE? I purchased one machinery. Okay. My intention is I want to give rentals to others. So yeah, it comes under the definition of PPE. Only with respect to the land and building, and the purpose is rentals to others, that only not comes under PPE. Then second aspect, here they use the word and. Okay. But they are used the word here or. If you use it for any one purpose, then it's enough, it comes under the definition of PPE. But apart from this, one more condition is there. First condition is with respect to the purpose, and second condition is with respect to the time. So expected to be used for more than one period. Expected to be used for more than one accounting period. So I bought one asset. My expectation is I am going to sell it in the nearby future. Like for the next month alone, I want to sell it in the future. Then it will not come under the definition of PPE. Okay. So two aspects. Expected to, only expectation. Okay. I bought one asset with an expectation of using it in for 5 years. But due to technological obsolescences, because of advanced technology came into the market, this machinery I cannot be used in this one. In that case, I want to sell it in the next month itself. But so I already purchased 1 month back, right? So I cannot say that you are wrongly classified. I have classified correctly only. I am talking about only my expectation. My expectation is going to be used it in the future for more than accounting period. So based on that expectation, I am going to classify this assets under PPE. Okay. Then let's come through the recognition criteria. What is the recognition criteria? PPE is recognized in the books under assets only. So now PPE definition is satisfied. And let's see the recognition criteria. So after the satisfaction of the PPE, whether can I record this PPE in my books? Yeah, you can able to write the PPE only if you satisfy two conditions. First thing, probable future economic benefits will flow to the entity from the use of the asset. And second, cost of the asset can be measured reliably. If any one condition is not satisfied, then we cannot recognize it because they use the word and. I want to satisfy the both conditions cumulatively. Super. Then, so I have decided the both conditions satisfied, then I want to record it in my books. At what amount? So I have decided that I want to classify the asset under PPE. So I can use the ledger account PPE. Then can I record it in books? Then I check for the recognition criteria. If these two conditions are satisfied, what are they? Probable FEB should flow to the entity. FEB means future economic benefits. Future economic benefits. Okay. Then I can able to record this PPE in my books of accounts. Like I am going to provide one journal entry with respect to this asset. So journal entry means one debit aspect, one credit aspect. One debit aspect is going to be PPE. Then what is the debit amount? Okay. For that, I should do the initial recognition. Initially, while recognizing, at what amount I should record this PPE in my books of accounts. Let's see. He is saying as per Ind AS 16, the PPE should be initially recognized at cost. No, it's not. Whether you can follow cost model or revaluation model, the initial recognition criteria is the same. So every PPE should be recognized at cost. Let's see what is the cost. There are there is components of cost. So the entire cost element is divided into three parts. First part, purchase price. And second element is directly attributable cost. And the third element is initial estimate of cost of dismantling, removing and restoring. Okay. So here, before going into this discussion, I want to give you something. So if you want to record any asset or record any liability, there are two aspects. I'm talking about the broader view. I'm not talking about the India 16 or financial instruments. I'm talking about the broader view. So with respect of the assets, I can record this asset initially with the two approaches, whether cash outflow approach and cash inflow. Cash outflow approach and cash inflow approach. So we can record the asset at which value. So how much cash out, okay, because of this asset, or how much how much cash outflows are incurring out of my pocket to acquiring or to purchasing this asset. So that is the cost of the asset, or we should record the asset at that value. Or second aspect, how much cash flows are generated from the usage of this asset in my business, and I can do the present value of the future cash inflows because of this asset, and I can record this asset at a value of present value of the future cash inflows. This is cash inflow approach. But with respect to the Ind AS 16, they are following cash outflow approach with regard to recognition of asset. So with respect to the Ind AS 16, we are following cash outflow approach. So cash outflow means we will incur cash outflow today or in future also because of this. So cash outflow means here present cash outflows, we should consider present cash outflows and future cash outflows also. So present cash outflow and future cash outflow. Okay, but we should record the asset today, right? Then what I am going to do? So I am going to do present value of future cash outflows. Future cash outflows. Okay. Then coming back to our discussion. So Ind AS 16, PPE should be recognized at cost. So the asset should be recognized at cost. Let's see what is the cost here. Cost means purchase price, directly attributable cost, and initial estimate of cost of dismantling, removing and restoring. Here the purchase price means it's cash outflow. What I am saying, I told you cash outflow approach is following with respect to Ind AS 16 for the recognition of the asset, right? So this is present cash outflow, purchase price, present cash outflow, then directly attributable cost. So this is also a present cash outflow. Then what is the third element? This is future cash outflow. So this is the, we are going to incur in the future, but I wanted to record it in today, right? The value of the asset, so I can do present value of the future cash outflows, present value of the future cash outflows, and I can add it up to the present cash outflows. Then I got the cost of the PPE. So I will give you the example. I wanted to install one machinery in my organization. So I wanted to install my one machinery in my organization. This is a huge machinery. So of course it will occupy the entire one floor of the building. So that is the like size of the machinery. So I have ordered it. So it bought through the, so I have ordered it from the foreign. Just giving the example to make you understand what is the aspects, what is the three aspects. Only small example, it will not take much time. Let's listen it. So I have ordered one machinery from the foreign, so I should pay purchase price, right? So I have paid purchase price 1 lakh rupees. Then after that I should, so I have imported it, right? It is imported to the Mumbai. So from Mumbai to, I should shift it to the Hyderabad. So I should incur transportation expenses, right? So transportation expenses, let's say 10,000. Okay. Then now what my plan? My plan is I wanted to install this machinery on space. So it is to huge machinery, right? I already told you. To install this machinery, I have taken one building. I have taken one vacant place. Okay. I have taken this vacant place, but in that place already one small structure is there. Small construction is there. So I told that owner, so I wanted to install my machinery. So I wanted to take this vacant land for the installation of this machinery. And he told to us, yeah, but there is a construction in this place, right? So how can I give this to rent? And I told him that, sir, once I want to dismantle this construction now, I will install my machinery here. I will work for 5 years, and after that, while I am living from here, I will reconstruct your building as it is. Okay, that is the deal I made with him. So, with respect to make this machinery to use in my production activity, what are the cost I am incurring? 1 lakh rupees, 10,000 rupees today. Today what I am incurring? Today cash outflows are this 1,10,000. So apart from that, so I am going to incur some part. So to make, to construct this small structure again, I am going to incur how much? 2 lakh rupees in the future. Sorry, not 2 lakh. I am going to incur 50,000 in the future. So after 2 years, let's say 2 years. So after 2 years, for the construction of that small building again in that place, I should incur 50,000 after 2 years. So this is the cash outflow after 2 years. But I should not directly include this 50,000 today, because this is not incurred today, right? I am going to incur in the future. So I should find out the present value of this 50,000. Why you are incurring this 50,000? For it is restructuring cost. It's called restructuring cost. Okay. Then coming to our example. So initial estimate of cost of dismantling. So why they are using the word estimate? But I don't know what is the future. It's our future. Always futures we are made with the estimations. So I made some estimation with respect to the dismantling, removing and restoring. Dismantling means for the dismantling of the whole thing, I should incur the expenses, right? So dismantling and removing means if I wanted to remove this machinery from here, should incur the cost. So because of this machinery, I am incurring the cost, right? But not today, in the future, and as well as restoring. So I have taken one floor of the building. So I have installed my machinery. For installing it to the floor, so what I am going to do? So I use the entire floor. So once I have removed the machinery from this floor, the entire ground is so much scrabbled. Okay, now I wanted to make this floor as it is, how it becomes originally when I have taken for the lease. So for that I am going to be incur in the future, right, expenses. Why all these expenses? Just because of purchasing of this machinery. Okay, so each and every cost which are related directly attributable to the of this machinery should be added to the cost of the asset. That is the primary element. Let's see what is the purchase price. They are giving the purchase price, right? So let's see what is the purchase price. List price of the PPE. Then I should deduct trade discounts and rebate. Then I should deduct trade discount and rebate, and after that I should include import duties and taxes, only non-refundable. If it is refundable, so if it is refundable, I should not be considered in the purchase price. If at all already included in the purchase price, I should deduct that. If not at all included in the purchase price, I am not considering, I should ignore it. Then I got the purchase price. So what is the formula for the purchase price? List price of the PPE. From that I should deduct the trade discount and rebate. And after that I should include import duties and taxes. Okay, then cash discount is not deductible. Okay, cash discount is not deductible because why they are giving the cash discount? For early payment. It's not respect to the asset. Okay, so this cash discount is getting just for the early payment. So it's a financial aspect, so that's why it will not affect the cost of the PPE. Then if the question is silent, assume taxes is always non-refundable. The GST should not be added as it is refunded in the form of input tax credit. Okay, so in some questions also we can say that GST accounting is ignored. If you write it down the word GST accounting treatment is ignored, then you no need to consider the GST also. Okay, but if at all GST is not added as it is refunded in the form of income tax credit. So these are the aspects with respect to purchase price. Let's see what is the directly attributable cost. These lines are very important. These lines should be noted down while you are solving the answer. These theory aspect, this line should be presented whenever you are going to solve the problems of the PPE with respect to the cost calculation. Always you should use the word all the costs, those are necessary to bring the asset to the present location and condition as intended by the management. So what is meant by directly attributable cost? All the costs, those are necessary to bring the asset to the present location and condition as intended by the management is called directly attributable cost. Here all our focus should be not all the cost. Please make some change. All the direct cost. All the direct costs that are necessary to bring the asset to the present location and condition as intended by the management should be included to the cost of the asset. So these are the definition. Let's see the examples. So what is meant by directly attributable cost? Employee cost for the construction or acquisition of PPE. So sometimes the properties or plant and equipments are very huge, machineries are there. Thus machinery we cannot purchase it just like that. We need to import the spare parts of that machinery from the different countries and we should assemble it in one place. For that it will take some time for the construction of this machinery. For this construction, if you use any employee cost, if you have incurred any employee cost, then we can include those employee costs to the cost of the PPE. And cost of site preparation. To install this machinery, so I should make some cement beam. So I should make some construction to support this machinery to avoid the vibration of that machinery. So if at all any expenses incurred with respect to the cost of the site, so that also should be included to the cost of the PPE. Then freight and delivery cost. In our previous example, I have purchased one machinery, right? From bringing the asset from the Mumbai to the Hyderabad, I have incurred the freight and delivery cost. That should be also included. Then installation and assembly cost and the professional fee, architect fee, consultants fee and advisor fee. All these costs should be added to the cost of the asset. So all these elements are coming under the questions. So you should remember these aspects. Okay. Then cost of test run. Before before directly using the production process, before that I should make some test run, right? So cost of the test run also should be included to the cost of the asset. But here point, so test run means by using that machinery, I am should able to produce the products or not. I am just checking it. If you are able to produce some products, and you can sell that product, right? So cost of the test run is, for example, 15,000. So to make this setup everything for the commencement of the production process, I have incurred of 15,000 rupees. But after that, some test products have been produced, right? So I sold the test products in the market. I got 12,000. Then what is your net cost of test run? 3,000 rupees. This 3,000 should be added to the cost of the asset. Okay. For example, your cost is going to be 15,000. But if you sold the cost, I mean sample items in the market, you have got the 16,000 rupees. Then this 16,000, what you are going to do? So the balance is amount minus 1,000 rupees, right? This 1,000 rupees should be deducted from the cost of the asset. Okay. You are not supposed to transfer to the profit and loss account as a gain. If it is a net expenses, you got net expenses, then it should be added to the cost of the asset. If you got net income because of the sale of assets is greater than the cost of the test run, then the amount should be deducted from the cost of PPE. Okay. And let's see what is the third element. What is the third element? Initial estimate of dismantling and removing and restoring. These are the future cash flows. Future cash outflows. Initial estimate of dismantling, removing and restoring. So recognize this cost at the present value of the estimated dismantling and removing and restoring site on which PPE is located. Okay. So once we are solving the problem, you can get the better clarity. So if you are going to incur 5 lakh rupees with respect to the dismantling of this machinery or dismantling of some assets over there, in that case, the present value of those expenses should be included to the cost of the asset today, because I should present this asset in my balance sheet today itself, right? So at what amount I am going to recognize my asset? Present cash flows plus future cash flows. I cannot present cash flows plus future cash flows, right? So that's why I made the present value of the future cash flows and should be added to the remaining cash outflows at the initial day of the recognition. Then let's see what are the following items are not included in the cost of PPE. That's what are they. So cost of staff training, administration, selling and general overhead. What is meant by overheads? I'm asking, what is meant by overheads? Overhead means indirect expenses. Overhead means indirect. Okay. So, but as per the definition here, directly attributable cost means all the direct costs that are necessary to bring the asset to the location and condition as intended by the management. Here they are only discussed about the direct cost only should be included to the cost. So overhead means it's an indirect cost, and in that case indirect cost should not be included to the cost of the asset. Then advertising and promotion of the cost of the new product. So inauguration cost, this also should not be included to the cost of the asset. And cost of relocating for conducting the new business. So already installed machinery here. 1 minute, I will write it properly. indirect costs or indirect expenses. So advertising and promotion cost of the new product and cost of relocating for a new business. So all these are should not be included in the cost of this. I already installed this machinery in my one Hyderabad branch. Now I wanted to relocate my now I wanted to relocate my business from Hyderabad to Vijayawada. So what I am going to do? I should shift this machinery also, right? So for shifting this machinery, I should incur some transportation expenses, right? And am I include these transport expenses or am I should added these expenses to the cost of the machinery? No, because these expenses are incurred for the relocating the business. So it should be transferred to the P&L. It should not be added to the cost of the asset. Then initial losses. Initial losses should not be added to the cost of the asset. And the purchase of the maintenance contract of the PPE. For the better maintenance of the PPE, also I have purchased the maintenance contract. These maintenance expenses should be added to the cost of the asset. No. So then I will give you why. And interest cost on loan taken to buy or construct the PPE. So this interest cost also should not be added to the cost of the asset. Of course, there is an exception. So if it is not satisfying the Ind AS 23 requirements, then we should not be included to the cost of the asset. If it is satisfy the Ind AS 23 definition, then we should be included, and that part we will discuss in Ind AS 23. Then early settlement discount. Early settlement discount means cash discount. Then cost of abnormal wasted material labor during the construction of PPE. Okay. So what are the abnormal waste of material and labor? Following items are not included in the cost of the PPE. So I don't know which type of items covers under PPE or not. Let's see one time frame. Okay. So I have started the process from 1st January 2025. Okay. So I thought of purchasing one big machinery, or I thought of constructing one machinery at my premises. Okay, so I have ordered on 1425 and I have given an advance of, so I have given the entire purchase price of 5 lakh rupees to them. 5 lakh rupees to them. Okay, and after that I have received machinery on 1325. Okay, so I should pay the duties and taxes. That too, it is are non-refundable. We cannot claim it as a refund, or we cannot get the ITC also. So non-refundable duties or taxes. So 2 lakh rupees. Okay, so I received at port. I already told you, Mumbai port. So at Mumbai port, I paid the duties of 2 lakh rupees, and after that, I have incurred transportation charges to bring the asset from the Mumbai to Hyderabad. So transportation, so it will reach to my location on 1425. So it is reached to my location. So to reach to my location, I have incurred transportation cost of 50,000 rupees. What are the transportation cost? 50. Transportation cost 50. Then after coming here, I should install it, right? So the machinery is installed on 1625. Installation expenses 20,000. Okay, so here my point is all the expenses which are incurred. So from this date onwards, the installation is completed on 1625. From this date onwards, I can use the asset in my business. So the asset is ready to use, or the asset is put to use in my business. sometimes ready to use and put to use dates are different. In that case, I should take the put to use. But here our understanding purpose, I just writing the ready to use or put to use. If the asset is ready to use or the asset is put to use in the production or in the ordinary business activities or in your business, in the business, ready to use in the business, okay. Then from that onwards, you should stop the capitalization of the expenses with respect to this plant and machinery. So all these expenses are incurred because of this plant and machinery. So what is the definition here? So I should capitalize means I should add it to the cost of the asset all the expenses directly attributable because of this plant and machinery. Okay, the plant and machinery is installed on 1/6/25. So after that, some maintenance expenses are incurred on 1/7/26 of 1 lakh rupees. Can I added these 1 lakh rupees to the cost of the PPE? No, not supposed to do that, because so I should add it to the cost of the asset only those expenses which are incurred prior to the ready to use or put to use. Once it is ready to use or put to use, on that date what I am going to happen? I am going to incur, I am going to generate incomes. If I go into generate incomes, those incomes are transferred to the P&L. So whatever the expenses incurred with respect to the generation of these incomes should be transferred to the P&L. Why these expenses? Or why these 1 lakh rupees expenses are incurred? Because of maintenance expenses. Why maintenance is required? Because the production is going on, the machinery is going in the revenue generating activity. That revenue is transferred to the P&L, right? So the revenue, the expenses which are related to or which are used for the generation of those revenue. So that's why this 1 lakh should not be added to the cost of the asset. But sir, before all expenses are done, why you added to the cost of the asset? Because before all this, I am unable to generate the revenue because of these expenses. So that's why I am not supposed to transfer to the P&L. If I wanted to transfer these expenses to the P&L, whether am I generating any revenue because of these expenses? No, right? So that's why these expenses should be capitalized, means added to the cost of the asset. Okay. So all the expenses, that too not these expenses. The expenses other than the following expenses should be added to the cost which are incurred before the ready to use or put to use. So if you want whether it is ready to use, put to use, I can strictly say that put to use. You just need to check for the put to use date. So until then you can capitalize all your directly attributable expenses or eligible expenses as per the definition. And let's see now. Purchase asset value. Now how to purchase these assets? There are different modes of purchasing of this PPE. Depends on the different types of PPE also. Depends on the different ways of acquiring this PPE. So my aspect is recognition aspect is going to be changed. So first PPE purchases in exchange of other asset. So from all these aspects, if the PPE is purchased for the cash price, so all these expenses are incurred in terms of the cash outflows, right? Then I have recorded it, the asset. Now what is the second aspect here? I have purchased asset but not for the cash in exchange of another asset. In that case, now I wanted to record the asset in my books, right? So for the recording of the asset, what I have told you, we can follow cash outflow approach. But here not cash outflows are incurring. Here assets are going, not cash. In this case, how can I recognize this newly acquired PPE? Your first preference, fair value of the asset given up. Whatever the asset we are giving for getting this PPE, I'm talking about at what amount this PPE should be recorded in my books. Okay. Now, what I am getting here, in our previous discussion, I am acquiring this PPE. In return, I am giving the cash. At what value this PPE should be recognized in my books based on the how much cash flows are going out of my pocket depends on that approach. I have recognized it in my books. Now, I am not giving cash here. I am giving another asset. Now, at what value this asset should be recognized in my books? So the fair value of asset given up. I need to find out the fair value of the asset given up. So I should recognize this asset at fair value of the asset given up. If the fair value of the asset given up is not available in the question, or we cannot in practical aspects also, if the fair value of the asset given up is you are not able to find out the fair value, then that case take the fair value of the asset received. I know the fair value of the asset received, right? If you have the information regarding with the fair value of the asset received, recognize this asset at the fair value of this asset. Okay. Then, what is the third preference? Carrying amount of asset given up. I don't know the fair value of the asset given up. I don't know the fair value of asset received. In that case, I should recognize this, whatever the asset I have acquired, this asset should be recognized in my books at a value of the carrying amount of the asset given up. I am giving this asset, right? How I am giving this asset? Previously, this asset is held by me. If it is held by in my business, I should have carrying amount, right? Fair values are unable to determine. In that case, I can use the carrying amount of the asset. Okay. These are the values. Here the question is, at what amount or at what value I should recognize this asset in my books of accounts. The first option, fair value of the asset given up. This asset should be recognized in my books at a fair value of the asset given up. Second option, fair value of asset received. Third option, carrying amount of asset given up. Okay. Next one, if the cash is received along with the exchange of the asset, then should be deducted from the cost of the asset. If the cash is received along with the exchange of the asset, then it should be deducted from the cost of the asset. The cash is paid along with the exchange of the asset, then it should be added to the cost of the asset recognized above. Okay. What they are saying, let's say I wanted to exchange my old asset with the new asset. Now, basically, I wanted to purchase one new asset, like I wanted to purchase one new car for using in my business aspects. Then only it satisfies under PPE definition. Okay. So the new car, I wanted to use it for the administrative purpose, so I have purchased it. But how I purchased it? Not giving the cash entirely. So I have given my old car. So I acquired the new car by giving my own car. This new car should be recognized at which value? New car should be recognized at fair value of old car. So the new car price, I went to the showroom, I asked for the price, he said 55 lakhs. The new car price is 55 lakhs. I have taken my old car. Now tell me how much you should pay for this old car. The old car price is, so he ready to pay 30 lakhs for this old car. He ready to pay 30 lakhs for this old car. So I wanted to exchange it. So what is this 30 lakhs? This 30 lakhs is called fair value of old car. If I sell it in the market, I can able to get 30 lakhs from this old car. So I am exchanging this old car. So apart from this, cash is also paying. I am giving, what are the outflow aspects? Outflow of one old car. What are the next outflow? Cash. How much? 25. Now, the new car should be recorded at a value of fair value of the old car, that is 30 lakhs, and the total amount of the cash outflows, 55 lakhs. Okay. Then instead of that, I can write it as, they are saying, sir, the fair value, we wanted to purchase this car in the market, the fair value of the new car is 60 lakh rupees. So I have the availability of the information regarding with the fair value of the new car is 60 lakhs. But the fair value of the old car is 30 lakhs. If you want that new car, you should pay cash of 25 lakhs. At what value I should recognize this new car in my books of account? What is my first preference? I should give the preference to fair value of the asset given up. What is the fair value of asset given up? 30. And what is the cash? 25. So I should recognize this new car at 55 lakhs instead of 60 lakhs. So I should ignore it. For example, this fair value of the old car is not available. Then how can I solve this problem? Asset received. So what is asset received here? 60 lakhs. Directly I can recognize asset as 60 lakhs because this 25 lakhs is already included in this 60 lakhs value. Okay. Then third aspect. I will change the example to suit with this line. The cash is received along with the asset. Now I am changing the example. I wanted to purchase the new car. But it's only normal thing like Tata Punch. I wanted to purchase the Tata Punch because the sales are too good, and that too with hybrid features. We can use the diesel or as well as the gas. So I wanted to purchase it. The fair value of the new car in the market is 15 lakh rupees. This is the fair value of new car. But my old car is Rolls Royce. So even though it is old, the fair value of this old car in the market is 35 lakh rupees. How much? 35. This is the fair value. Now I wanted to exchange my Rolls Royce car with the purchase of new car. Now how much this new car should be recorded at what value? So I am receiving how much? I am going to receiving 12 lakhs. Just receiving 12 lakhs from him. I am giving my old car. Okay. I am getting the new car. And apart from the new car, I am getting the cash of 12 lakhs also. Now at what value I should record it? The new car should be recorded at which value? No. Fair value of the old car is available and fair value of the new car is available. Now I wanted to record the new car in my books of accounts. At what value I should record it? I should record it for fair value of the asset given up. What is the fair value of asset given up? 35 lakhs. Apart from this, I am getting the cash also, right? Cash is received along with the exchange of asset. Then this 12 lakhs should be deducted from the cost of the asset. Then the cost of asset, fair value of asset given up. But if a cash is received, that cash should be deducted from the cost of asset. Now tell me, 35 minus 12, 23 lakhs. The new car should be recorded in my books of accounts at 23 lakhs, not 15 lakhs. Okay. Then third mode of asset acquired on credit basis. So I'm just modes of acquiring. I wanted to write modes of acquiring. Modes of acquiring PPE. Modes of acquiring PPE. First aspect, second aspect, third aspect. So I have acquired a PPE by paying the cash. In that case, I can record directly at cost. Okay. Then I have acquired PPE by exchange of asset. So I should record it fair value of asset given up. This is the first preference. What is the second one? Fair value of asset received. Carrying amount of asset given up. This is the first option. This is second option. This is third option. You will need to follow the order. Okay. Doesn't mean that you can follow any of option. You need to follow order. Follow order. Okay. What is meant by cost? Cost contain three elements. What are they? Purchase price, then directly attributable cost, and what is the third element? Present value of dismantling cost. You note it down properly. Okay. Now, what is the third element? No outflow is today. There is no outflow of the cash. There is no outflow of the asset. So I have purchased this asset on credit basis. If you purchase the asset on credit basis, so at what value I should record the asset? So I am following the recording this asset in my books of accounts outflow model. So there is a cash outflow. So I should find out the how much cash is outflow today, how much of asset is outflow from today. And here, with respect to the credit basis, there is no outflow today. Then at what value I should record this PP in my books of accounts? So if the PP is acquired by EMI, if the PP is acquired by taking a loan from the bank, PPE should be recognized at cash purchase price. Okay. If in the question is directly available, this is the cash purchase price. For example, the cash purchase price is 1 lakh rupees. But if you wanted to purchase this asset on EMI, so you should pay total 1,20,000 rupees. Then PP is acquired by taking a loan from the bank. So I will tell you the example with respect to the PPE acquired by the EMI. PPE acquired by EMI. Let's see. Want to purchase one. We want to purchase one machinery. Okay. I wanted to purchase one machinery. I asked what is the price. So I wanted to purchase the machinery today itself. He said you should pay the 1 lakh rupees if you wanted to purchase this machinery today. So if I given the 1 lakh rupees cash today, I got the machinery. But I have an option. You can pay the in installment every month, like 10,000 rupees, 10,000 rupees or something. Then every month you should pay EMI 10,000. So you should pay up to 12 months. 12 months. So then what is my cash outflow? 1,20,000. Here generally how am I recognizing my asset? Cash flows, right? So how I am recognizing my asset? Cash flows. Now they are saying that if I wanted to opt for the EMI, you should pay 1,20,000 rupees. But out of this 1,20,000 rupees, how much I paying for acquiring of the asset? For acquiring of this asset, I am paying 1 lakh rupees for asset. Then why you are paying this extra 20,000? This 20,000 is paying for defer your payment. Okay. Actually, you should pay the amount of 1 lakh rupees today, but you wanted to defer it. So you will not pay the amount entirely on today itself. So you wanted to pay it in the future. For deferment of your payments, they are charging the interest cost, that is 20,000 rupees. This 20,000 rupees is not paid for the acquiring of the asset, but as per the India 16 PP definition, the directly attributable cost, the expenses which are incurred only for the acquiring of the asset should be included to the cost of the asset. So that's why the machinery should be recognized at cash price. If at all the cash price is not available, in that case, you should record the asset at present value of the future cash flows. Present value of the future cash outflows. Then what are the interest expenses there, right? That interest expenses should be transferred to P&L account. Then PP acquired by taking a loan from the bank. Generally, this interest cost should be transferred to P&L account. But as per the Ind AS 23, if this loan amount is spent on the qualifying asset, then the interest amount paid on such loan should be added to the cost of the asset as per Ind AS 23. That aspect we will discuss in Ind AS 23. Okay. So these are the initial recognitions. So initially, these are the modes of acquiring the assets. Initially. So initially, I should recognize my asset at cost if you purchase for the cash. Initially, if you have acquired this asset by exchange of asset, thus that new asset should be recognized at fair value of the asset given up or follow this order. Thirdly, if you are initially acquired this asset on credit basis, you should record the asset at cash price. Okay. If the cash price is not available, you can do the present value of future cash outflows. Future cash outflows. Okay. So initially this is the discussion. So let's see the problem with regard to how to initially record this asset in my books of accounts, the practically. Okay. We will look at the questions. So before going to it, let's take a break of 10 minutes. Okay. Please take a break of 10 minutes. Ten minutes. Hello. Okay. The break is over. Since everyone came, ready for the class? Okay. And let's start. Please open the workbook. Question number 1. So X Limited sets up a plant at a purchase price of 5 lakh rupees. So let's see the first question. So what they are asking, measures the initial cost to be recognized and pass the journal entry. So X Limited purchased one plant. So now what is the question exactly? So they are asking what is the initial cost of that plant. With respect to that, we should pass the journal entry. So at the initial recognition, if the mode is, if we acquired this plant by paying of the cash, then what? That the plant should be recognized at cost. The cost contains 3 elements. So purchase price, directly attributable cost, and as well as present value of the dismantling cost. So let's identify the given information. Let's identify the cost elements. So X Limited sets a plant at the purchase price of 5 lakh rupees. So this 5 lakhs comes under the element 1. So cost is divided into 3 aspects, 1, 2, 3. The first aspect is purchase price, second is directly attributable, third is present value of dismantling. Let's identify the aspects from the question itself. So 1, and there is a GST of 18%. This also comes under 1 because in the purchase price definition, list price minus trade discounts minus plus non-refundable taxes and duties. So GST is not refundable, not non-refundable, it is refundable in the form of ITC. So it should not be considered while calculation of the cost. Then freight paid 20,000. This it comes under the directly attributable cost. The respective GST also comes under directly attributable cost, but it should be ignored. Then paid 10,000 rupees. How much? 10,000 as employee expenses for installation. This also comes under directly attributable cost. Then after the plant was put to use, maintenance cost incurred. When the expenses are incurred? The expenses incurred after the plant was put to use. So okay, the expenses incurred after the plant is put to use, those expenses should be transferred to P&L account as per the matching concept. This should be transferred to P&L. So it should not be considered under cost of the asset. Then the estimated dismantling cost is 30,000 rupees. But generally we should not record or should not add this 30,000 to the today value because these 30,000 are incurred after few years. So I should record present value of the future cash outflows. So this is 12,000. This comes under the aspect number 3. Okay. So the asset is recognized in the class machinery under the item of PP in the non-current group of the asset. So in the balance sheet, so in the 1 minute, so in the balance sheet itself, so I just wanted to record under property, plant and equipment. This is comes under non-current assets. Non-current assets under property, plant and equipment. this plant should be recognized because I purchased a plant. So generally I have taken the default assumption of I may use it for more than one accounting period, and that too plant is a tangible item. Why I am purchasing this plant? For the production of the goods. So it satisfies the definition of the PPE, and as well as I can able to find out the future economic benefits and the cost of the measurement reliably. So I can record this asset. Then what is the, at what amount I should record this asset? At cost, because the mode of acquiring of the plant is at cost. So mode of acquiring of the plant is at cash. So I can record the present values of, the total amount of the cash outflows. So let's see what are the cash outflows because of this machinery. That too, I cannot add all the expenses, I should add only directly attributable expenses. So what is the first aspect? Purchase price. How much? 5 lakh rupees. You can add it. What is the next element? Can I add GST in my cost? No, it is refundable taxes. Then what is the freight? Freight is 20,000 rupees. It's a directly attributable cost. I can include in the cost of the asset. Then the GST, again it is non-refundable, should not be considered. So it's a refundable, okay. Then installation cost 10,000 rupees. Then present value of the dismantling cost 12,000 rupees. These 5,000 should be transferred to P&L only. So what is the total cost of this asset? 5,42,000. I should pass the journal entry for this, okay. So number 1, let's see the journal entry. So calculation of cost of asset. Lakh. Purchase price 5 lakhs. Next, freight. Installation cost 10,000. So how much installation? 10,000, okay. Present value of dismantling cost 12,000. So what is the total cost? 5,42,000. Sorry. So the PPE should be recognized in my books and initially at cost. So the journal entry should be, so here I should pass the journal entries. Journal entries in the books of, what is the company name? X Limited, right? Okay. And what is the cost of asset? 5,42,000. So planned account debit 5,42,000. So how we paid this 5,42,000? So this 5,42,000 means total cash outflows. Out of this, present cash flows is there, future cash flows is there. Future cash flows is we are not going to incur today, right? So how much cash? So with respect to this purchase price, this is today cash flows, right? So this is present cash flows. Freight is also present cash flows. Installation is also present cash flows. But am I paying this 12,000 today? I will pay it in the future. So 5,30,000 is paid today in the form of cash. Remaining 12,000 is we are deferring. I am going to pay it in the future. So I should pay it as a liability. So liability for dismantling cost. Okay. Liability for dismantling cost, how much? This is 12,000. So this is present cash outflows, and this is present value of future cash outflows. Of course, this 12,000 is going to be pay in the future. Okay. But I will not pay 12,000 in the future. Okay. Along with the interest, I will pay. Okay. Because this 12,000 should be increased every year by giving the discounting factor. Then it is going to be 15,000 at the end of the year. Sorry, at the end of the this period. At that time, I should pay in the cash. So this is with respect to present value of future cash flows. Now, this is one element. Then second element. Did I cover everything? No. Still, sorry. GST aspect is there, right? I should pay in the cash, right? Because I should, along with the 5 lakhs, I should pay 18% of GST to the supplier, right? So the supplier will pay to the government. But initially, it comes, I should incur out of my hands. So, how much input GST? So whether it is interstate or intrastate, intra means IGST generally, but question CGST, so you just change here. Okay. Intra means within the state. CGST and SGST. Let it be. Sorry. So input CGST. Okay. And input SGST. So there I have paid 2 GST elements on the purchase price as well as on freight. So let's see. So GST, CGST on purchase price. So what is the total here? What is the purchase price? 5 lakh into, so how much they are saying, how much they are giving? So 18%. 18% means 9% CGST, 9% SGST. So in that case, you can write it as GST on purchase price equal to 5 lakh into 18%, 90,000. Out of 90,000, CGST 45,000 and SGST 45,000. Then GST on freight. What is the freight amount? 20,000 into 18%. How much? 3,600. Out of this 3,600, CGST 1,800 and SGST 1,800. Now what is the total CGST you have paid? 45,000 plus 1,800, 46,800. And SGST also 46,800. This entire CGST you paid through the cash. Okay. So to cash account, how much? 1 lakh. So 90,000 plus 3,600. 93,600. Okay. So we are showing this input CGST and SGST as assets because we are going to use these assets in the future for the settlement of the output GST liability. And what are the remaining aspects? Did I cover everything? No. So there is 5,000, right? This 5,000 rupees I have left. So this 5,000 should be transferred to P&L. So installation expense account debit to or cash. Maintenance expenses account. How much? 5,000 to cash. This 5,000 should be transferred to P&L. So P&L account debit to maintenance expenses. To maintenance expenses. 5,000. 5,000. Okay. So I have passed all the journal entries with respect to the elements given in the question. Okay. So these are the elements. Okay. So they have passed consolidated journal entry. Okay. They have passed consolidated journal entry. Instead of that, we can provide the journal entry for each aspect separately. Okay. This is for the recognition of the asset. First journal entry. Second journal entry with respect to the GST. Third journal entry with respect to the expenses. Okay. Then let's see the question number 2. So on 1st April 2001, acquired a mission under the following terms. What is the list price of the mission? 80 lakh. What is the import duty? 5 lakh. Delivery fee 1 lakh. Electrical installation cost 10 lakh rupees. And pre-production testing 4 lakhs. And purchase of 5-year maintenance contract with the vendor 7 lakh rupees. So out of this, so here the element is, the focus is also at what cost I should recognize my asset in my books. So the cost is divided into 3 parts, right? So I want you to identify the cost parts. The list price of the machine comes under purchase price, that is 1. The import duty is also comes under, okay, import duty, whether it is refundable or non-refundable. Import duty I paid. So what is the default assumption? Coming to concept book. Super. The question is silent, assume taxes are non-refundable. So we can add it to the cost of the asset. Here the question is also silent whether the import duty is a refundable or non-refundable. Assume it is non-refundable. Super. Assumed it is non-refundable. Sorry. Okay. Assumed it is non-refundable, so I should add it to the purchase price. Then delivery fee directly attributable cost. Electrical installation cost directly attributable cost. Pre-production testing. So testing expenses should be included to the cost. So all these expenses are incurred. So one aspect I should check whether the expenses are incurred before put to use, after put to use. If it is before put to use, then I need to check whether directly expenses or indirectly expenses. So I should add only directly attributable expenses which are incurred before put to use. If it is after put to use, whether it is a direct or indirect, it should be transferred to the P&L. Okay. So purchase away contract with the contract. So why? Because it's a maintenance contract. When the machinery needs a maintenance, after it involves into the production. So these expenses are incurred after the machinery is put to use. So this should be transferred to P&L. And in addition to the above information, XYZ Limited granted a trade discount of 10% on the initial list price of the assets. So this trade discount should be deducted from the list price. Then settlement discount of 5%. What is meant by settlement discount? It's a cash discount. So cash discount should be ignored while calculation of the cost of the asset. Okay, this cash discount should be transferred to P&L account. Okay, but with this respect we will not show in the books. Okay. It directly reduces from the cost of the asset. That's all. Just we have taken into consideration while the calculation of the cost of the asset, but we will not record any specific journal entry to show this trade discount in my books. Deduct from list price. In calculation of cost of asset. Okay. Then why the settlement is discount is receiving? Because the amount is paid within the 1 month of the purchase. Then XYZ Limited paid for the plant on 20th April 21. Compute the cost of the asset to be recognized. So when we have purchased the asset on 1st April, so on that too we have paid the amount on 20th April only. So within 1 month they paid, so they can avail the settlement discount of 5%. Now compute the cost of the asset. Before going into the calculation part, so I already told you, for every type of these kind of calculation of the cost problems, you should start with the word in accordance with Ind AS 16 all the cost. Instead of all the cost, you can write all cost, all direct cost. That it should be gives more appropriate. So all direct cost required to bring an asset to the present location and condition as intended by the management should be capitalized. Capitalized means added to the cost of asset. Added to cost of asset. Therefore, the initial purchase price of the asset should be. So let's see the elements. This 80 lakhs should be considered in the cost of the asset. 80 lakhs. From this 80 lakhs, I should deduct the trade discount of 10%. 10% on what? 10% on initial list price. What is the list price? 8 lakhs. So 80 lakhs into 10%. Then 72 lakhs. For this, I should include import duty, then delivery fee, then electrical installation, then pre-production testing. So what is the total? The total amount should be 92 lakhs. Then what about this maintenance contract? Maintenance contract of 7 lakhs should be here. This 7 lakh rupees is there, right? But here the problem is they purchased the maintenance contract today. So they paid 7 lakh rupees today. But are we incurring any expenses today? No, these maintenance expenses are going to be incurred in the future. For future expenses, I paid today 7 lakh rupees. Then what is the journal entry for this? It's a prepaid expenses. So prepaid maintenance expenses account debit to cash account. This prepaid maintenance expenses should be shown as an asset. Okay, separately. But this prepaid maintenance expenses cost should not be added to the cost of the PPE. So that is the element, because these are the future expenses, future maintenance expenses. Those expenses are incurred after the asset is put to use. That's why it should not be added to the cost of the asset. Then should be taken as the prepaid expenses and charged to the P&L over a period of 5 years, because he has taken a maintenance expenses contract for how many years? 5 years. So proportionately every year should be taken. Then the settlement discount. How much is the settlement discount? 3,60,000 should be shown as other income in the P&L account. So yeah, everyone is going to be solve this problem. This 92 lakhs is easy. And if you are thinking that yeah 92 lakhs is completed, right, then my part is over, then that's wrong. So you should shown what to do with these remaining elements also. What are the remaining elements here? Settlement discount and maintenance. So we should give the accounting treatment for these two elements also. It's very important. Then only you can able to get the full marks. Otherwise you may get only 4 marks only, 4 or 3 marks. Okay. Then coming to question number 3. So B Limited has incurred the following transactions in respect of acquiring a plant in exchange of the old plant. So B Limited has incurred the following transactions in respect of acquiring a plant in exchange of an old plant. The old site was, see, the old site was dismantled at a cost of 8,000 and no estimated dismantling cost was captured for the old plant. The scrap from the old site sold at 1,000 rupees. The new site was constructed at a cost of 48,000. Here, what happened here, I will tell you. So I wanted to purchase one new plant, but the purchase of new plant is not through the cash mode. The first two questions are related to the acquiring through cash mode. Question number 1 and 2. Question number 1 and 2 with respect to the acquisition of the PPE. Then question number 2 is, question number 3 is with respect to acquisition of the asset by the exchange of another old asset. So let's see. So already old plant is there. With respect to the old plant, they forgot to capitalize the dismantling cost. Generally, for recording of the or for initial recognition of cost is present value of the dismantling cost also. While initial recognition of this old include the present value of the dismantling cost. Okay, now what is the dismantling cost amount? 8,000 rupees. Now, so scrap from the old plant site sold is 1,000 rupees. So what is the total cost? The total dismantling cost is 8,000 rupees. So 1,000 rupees is generated from the scrap. Then what is the net dismantling cost here? What is the net dismantling cost here? 7,000. 8,000 minus 1,000 rupees. This is the 7,000. Can I include this 7,000 to the cost of the old site, old plant? Yes, we should include. Generally, we should include the present value of the dismantling cost at the date of initial rate. But today, the old plant is going to be dismantled. So I wanted to how much? 8,000 rupees. But out of 8,000, 1,000 is written back as a sale of scrap. So what is the net dismantling cost? 7,000 rupees. So you forgot to include the present value of the dismantling cost at the initial rate. So you should include the total because you are standing on the today. Today what is your cash outflow? 7,000. This 7,000 should be added to the carrying amount of the your vote. So you should able to find out the revised carrying amount of the old plant. It will be useful in our calculation. I will say how it is. Then second element. What is the new site was constructed at a cost of 48,000. Okay. So old site is completed. So if I wanted to acquire, if I wanted to install this machinery, I want to prepare one new site. So the new site preparation is 48,000. Then the supplier of the new plant agreed to take away the old plant at a fair of 6,000. What is the fair value of 1,26,000? And what is the new plant price? 3,20,000 rupees. What is the carrying amount of the old plant? 1 lakh rupees. Okay. Then what is the present value of estimate of dismantling the site? 16,000. Which site? New site. Because I have prepared the new site, right? So to incur the construction cost initially. For dismantling of this construction, everything at the end of the new plant useful life. So I should incur in the future, right? So future the cost, I don't know how much, but he is given directly the present value of the estimate of dismantling the site is 16,000 rupees. Then wages paid for the installation of the plant 4,000. and for the trial run it's 1600, and the freight paid is 8000 rupees, and GST applies on supply of the plant is 18%, on freight 18%. It is intrastate, it is also intrastate. So loss amounted to 40,000 for the low capacity utilization of the plant after installation. When this loss is incurred, even though it is incurred before also, so it should not be taken, okay, generally. So it's an incurred after the installation, means after put to use. Then 10,000 was paid as a cost of launching the product to be produced from the plant. What is this cost? Cost of launching the new product. Already in our definition, we have got some examples, right? What are the exclusions from the cost of the PP in this? Initial losses and as well as cost of, okay, cost of launching the new product. Okay, cost of conducting the new business or advertising and promotion cost of the new product. All these should be excluded from the cost of the asset. Okay. Then out of this, let's see. Let's find out the carrying amount of the old plant. Then we will try to. So what happened now? Here what is the element? I am acquiring the new plant. Okay. I am giving the old plant. Along with the giving the old plant, I am paying some cash also. This aspect should be represented in my books of accounts. So I should record taking of the new plant also. I should de-recognize the old plant. So at what value I should de-recognize the old plant? At carrying amount. But here that is not the correct carrying amount. The carrying amount of the old plant is 1 lakh rupees. But I wanted to revise it because they forgot to add one aspect to the carrying amount of the old plant. There is some error. So I wanted to rectify it and I wanted to make the carrying amount to the revised carrying amount. I wanted to calculate the revised carrying amount. Then I should de-recognize that revised carrying amount from my books of accounts. Then after that, I should recognize the new plant in my books of accounts at the fair value of the old plant plus cash paid. So that is the aspect. Let's see. Question number 3. So what is the old plant original carrying amount? So now existing carrying amount rupees 1 lakh. So I am talking about the old plant. I wanted to calculate carrying amount of old plant, existing carrying rupees plus net dismantling cost. Net dismantling cost. So 8,000 minus 1,000, it is 7,000 rupees. Then revised carrying amount equal to 1 lakh 7,000 rupees. Okay. This is the revised carrying amount of old plant. What is the fair value of old plant? The fair value of the old plant is decided by the supplier at 1,26,000 rupees. So fair value of the old plant is 1,26,000 rupees. Here what happened? I am just giving my old plant. So I am asking him how much value are calculated for this old plant. He said 1,26,000. Indirectly, I am selling this old plant at 1,26,000, right? But what is my carrying amount? 1,07,000. And what is the profit on sale of old plant? Instead of sale, I can write it as profit on transfer of old plant. How much? 9,000. 19,000. Okay. Now I should recognize the new asset. Okay. Calculation of the cost of the new asset. New plant. Calculation of cost of new plant. Tell me the values. Construction cost, you can follow this order. What is the construction cost? 48,000. Construction cost 48,000. Then next element, new plant price. New plant price 3 lakh 20. So of course this 3 lakh 20 is settled by, sorry, of course, yeah. The new plant price is 3 lakh 20. So I should include this entire 3 lakh 20 because this 3 lakh 20 is settled by 1 lakh 26 is settled by giving of the old plant and remaining amount is settled by cash. So the new plant price entire 3 lakh 20 should be included to the cost of the asset, because how you are including this 3 lakh 20 means, so the new plant should be, the new plant is acquiring, right? So the acquired plant should be recognized in my books at fair value of the asset given up. What is the fair value asset given up? 1 lakh 26,000. So along with 1 lakh 26,000, how much cash is I am paying? 1 lakh 94,000. So fair value of asset given up plus cash paid is the cost of the new asset. So that's why I have included entire 3 lakh 20,000 to the cost of the asset. Then what is the present value of the dismantling site? 16,000. Recording with the sale proceeds of the trial run. So what is the amount? 1600. And what is the next element? Sorry, freight 8,000. Freight 8,000. Is there another elements? No. GST accounting treatment should be ignored. Then the loss, it has been incurred after the installation. So it's not that too, it is initial loss. It's not initial loss actually. Yeah, it's after, we can take it as a, it has been incurred after the installation. So the expenses incurred after the installation should not be added to the cost of this. You can take that point of view. Then 10,000 was paid as a cost of launching the new product. So this amount is not incurred because of this machinery. Okay. This is incurred for the cost of launching new product. So this amount should not be included in the cost of the asset. So let's see what is the total cost. 3 lakh 97,600. So I should record my new asset at 3 lakh 97,600. So let's see how to record this. New plant. New plant account debit. What is the new plant amount? 3,96,700. Whether this entire 397,600 is paid through the cash. So let's see how much amount is paid through the cash. 48,000 cash. Okay. Out of 3,20,000, 1,26,000 is paid through old plant. Okay. And remaining balance 1 lakh 1,94,000 is paid through the cash. And this 16,000 present value of dismantling side. So it's going to be incurred in the future. I am not incurring 16,000 today. There is no cash outflow of 16,000 today. If I wanted to settle this liability, I am going to incur 16,000. But I wanted to settle it in the future along with the interest element. Okay, so this is not the cash incurred today. So it's just a present value of future cash outflows. This 4,000, yes, it's a present cash outflow. Then trial and expense is also present cash outflow. And this freight is also a present cash outflow. So new plant account 397,600 account debit to. Out of this, how much cash you have incurred? And value of dismantling side, right? So liability for today. But am I paying it today? So that's why I'm recording it as a liability because I'm not paying today expenses. What is the today expenses? 16,000. Okay. Then what is the remaining element? Old plant 1,26,000. To basically, so what I should de-recognize my old plant. I cannot write old plant 1,26,000 because what is the carrying amount? 1 lakh. This is the revised carrying amount I am going to show in books. So I should de-recognize my old plant. So to old plant 1 lakh. So I'm just dividing this 1,26,000 rupees between the revised carrying amount. So 1,07,000. So to old plant 1,07,000. And to profit on sale of old plant. Yeah, we can write transfer. Profit on transfer of old plant, how much? 19,000. Then 1,26,000 is enough, right? So the 1,26,000 is came here. So 3,97,600 is settled down. Then what is the next aspect? Here we have living some element, right? So loss of, here GST is also there. So here I can write it down. So you no need to pass the journal entries with respect to the GST. So write one note point, GST accounting treatment is ignored. Then no need to write the accounts. No need to provide the journal entry with respect to GST. No sir, I wanted to provide the GST accounting treatment. You can provide, and already we have solved in question number 1. You can follow that. So but here my assumption is GST accounting treatment ignored. GST accounting treatment ignored. Whether it is refundable or non-refundable, I should provide the journal entry, right? Because the cash is going out of my hands. So the GST accounting treatment is ignored. So that's why I haven't provided any journal entries. Then what is the third element? Loss. How much is the loss? This loss should be transferred to P&L. Yeah, right. Then this 10,000 was paid as the cost of launching the new product is also transferred to P&L. Yeah, initial losses కూడా తీసుకోవచ్చు అప్పుడే కదా ఇన్స్టాల్ చేసింది జస్ట్ ఆఫ్టర్ ఇన్స్టాల్ just now they have installed, right? So we can take it as initial operating losses also. And in our concept book, we have directly given that initial operating losses should be excluded from the cost of the asset. Yeah, you can write it as a initial operating losses. Initial operating losses. Then, so but we have incurred the cash, right? So tell me the journal entry. I can directly, I'm providing the net journal entry. Okay. What is the net journal entry? P&L account, debit to cash account. What is the total amount here? 40,000 plus 10,000, 50,000. So what is the journal entries here generally? Okay, loss account debit to cash account and cost account debit to cost of launching the new product, right? So expense account debit to cost of incurring on new launch expense account debit to cash account. After that, it should be transferred to P&L. P&L account debit to loss account and P&L account debit to these expense account. Instead of that, I am providing the net journal entry for saving the time. If you want, you can elaborate it and provide the journal entry separately. Sorry, cash only is outflowing out of entry. Yeah, but for that I need to prepare the, okay, I will provide you the separate journal entries. So wait. Now, what is the element here? So loss, right? Cash loss and initial operating losses. So initial operating loss account debit, how much? 40,000. Then tell me the other element also. Cost of launching. Launching expenses 10,000. Okay. To cash 50,000. And what is the next journal entry? P&L account debit to, sorry, P&L account debit to initial operating losses. How much? 40. And to launching expenses 10,000. So the journal entry already I provided. What does it mean? So this debit aspect, this credit aspect is cash journal entry, P&L account debit to cash account. If you don't have time, you can provide net journal entry also. Okay. So am I covered each and every aspect? Yeah. So in that too, we should provide the note points. Why you are not taking these two elements? Which elements? Why you are not taking 40,000 as well as this 10,000 and as well as this GST element into the cost of the asset? Okay. For that, I should note down the note points. So I already noted down GST accounting treatment is ignored. That's why I haven't passed the journal entry. So GST is a refundable taxes. Refundable taxes. Hence, ignored in cost calculation. Second note point, initial operating losses initial operating losses and launching expenses. Should write the words also. Initial operating losses of 40,000, launching expenses of 10,000 should be transferred to P&L. Should be transferred to P&L because it is not incurred for the acquisition of the plant. It is not incurred for the acquiring of plant. You can write this. Okay. Then we will discuss the remaining aspects tomorrow. Okay. Take a break now. We will meet tomorrow. Okay. Thank you guys.